Good afternoon, boys and girls. It's Liberty Call for Tuesday, March 1st, 2022. Hope everybody's having a great day out there in the interwebs. It's your first time watching, please hit the subscribe button and share with friends and family. I would greatly appreciate it. And kind of a wild day in the markets. Again, back and forth. Markets were mostly down most of the day, but looking at some of the other investments out there as far as gold, silver, the other commodities, oil and gas, they've just been on a tear recently. So depending upon how your portfolio is set up, it might be a good day or might be a bad day. So I know this is something I've been preparing for probably about 6 to 9 months. So I've been ready for this, but unfortunately, a lot of folks who've been chasing the indexes, which have just been out of control the last almost 2 years, might be getting kicked in the nuts pretty hard right now. So anyways, all right, well, let's go ahead and jump into the indexes, see how they did today. The Dow Jones was down 1.76, closing at 33,294. S&P 500 down 1.59, closing at 4304. NASDAQ also down 1.59%, closing at 13,532. Small caps were down 1.7%. The VIX was up another 10.51% today. It was up 8% yesterday. Closed at 3332. So for anyone who's been following along, anytime the VIX is over 30, again, that's a real worry, something to really worry about and to pay attention to. If this continues for much longer, I might suggest making some adjustments because it might show that equities might be turning in a negative direction for the foreseeable future. All right. As far as outside the U.S., we had one green. Looks like it was Brazil, but South America and Western Europe was down. Lots of 3 and 4% I'm seeing here. The Russian markets were closed again today, and then we get into Eastern Europe, also down. And then we get into the Asian markets. They were all green. I don't even see a red anywhere. Let's see. That was Israel. So everything in the Asian markets was up, anywhere from slightly up to, let's see, what was the best one? Looks like the Taiwan weighted was up 1.39, the China A50 1.32, and the Nike was up 1.2%. So as far as March 1st in the books, looks like Asia did really well. Eastern and Western Europe, not so much. And here domestically, we were kind of in the middle. Not nearly as bad as the European markets, but certainly not as good as the markets over in Asia. All right. Let's take a quick look and see. Let me switch that. As far as first article I got here, just a market summary. S&P 500 slides as slump in bank stocks sparks see red. This is written by Yassine Ibrahim from investing.com. The S&P 500 fell Tuesday, paced by a slump in banking stocks as Treasury yields slipped on safe haven buying and a surge in oil prices dampened the economic outlook as Russia intensified its assault on Ukraine. The S&P 500 was down 1.7. Dow was down 1.8. NASDAQ down 1.7. Russia on Tuesday continued to advance on the Ukrainian capital, Kiev, after reportedly launching a heavy assault on Kharkiv, the country's second largest city. Regional banks, including SFB Financial, Zions Bancorp, and Regions Financial, led the sell-off in financials as U.S. government yields, which traded inversely to prices, were under pressure as investors sought safety amid the ongoing Russia-Ukraine conflict. The mega cap bank stocks were also hit hard, with JP Morgan plunging to 52-week lows. Wells Fargo and Company and Bank of America were also down sharply. As well as geopolitical tensions, U.S. Treasury yields have been pressured by expectations that the Federal Reserve isn't likely to raise interest rates as aggressively as initially expected. The odds of a 50 basis point has dropped, has dropped to about 1% from 34% last week, according to investing.com's Fed rate monitor tool. U.S. oil prices rose above $100 a barrel for the first time since 2014 as potential supply disruptions from ongoing geopolitical tensions offset the International Energy Agency's release of 60 million barrels of oil from emergency reserves to ease rising prices. APA Corporation, Chevron, and Occidental Petroleum Corporation were among the biggest gainers, with the latter up more than 8%. Big tech also kept broader market lower as risk-off sentiment overshadowed a slump in U.S. rates, which tends to boost growth corners of the market, such as tech. With the exception of Alphabet, Apple, Amazon, Microsoft, and Meta platforms were down more than 1%. On the earnings front, Target proved a big winner after delivering better than expected fourth quarter results and guidance that suggests that the pace of growth was likely to continue post-pandemic. Zoom video communications fell 6% as quarterly results that beat on both the top and bottom lines were offset by the first quarter and full year guidance that pointed to slowing normalizing demand for video conference software. RBC cut its price of target on Zoom to $200 from $300 as guidance signaled a material revenue deceleration, but the bank kept its outperform rating on the stock amid expectations that sentiment may be close to bottoming out. Lucid Group Inc. reported wider than expected loss as revenue fell short of estimates, sending its shares more than 14% lower. Economic data, meanwhile, showed U.S. manufacturing activity was stronger than expected in February, though supply chain woes continued to persist. The data does not reflect too much progress in the struggle to rebuild inventories and clear backlogs, Jeffrey's note said in a note. So, kind of a day in the markets. I think people are kind of coming to the realization that, the tear we've been on for, going on really since March of 2009. I mean, the market's just been on a massive, uptrend for, going on 13 years now. So it's to be expected. I mean, we're due for, a correction, recession, whatever you want to call it, bear market. It's due, but we'll see how long it takes the stragglers to catch up. All right, next article: Why Wall Street Can't Agree on Whether the Market Where the Markets Are Heading. It's written by Jared Blickery. All right, let's go ahead and dive into this. Investors are still reeling from a roller coaster ride, attempting to price in a bewildering array of sweeping sanctions against Russian entities, with all its attendant knockoff effects. There's a growing divide on Wall Street, with some saying that the worst is over and investors should buy the dip, while others are saying investors should be cautious and concerned about lingering tail risks. I fall into that latter. Dominic Wilson of Goldman Sachs Global Markets Strategy Team is wary of both surging oil prices and a Federal Reserve that might not dial back its hawkishness as much as markets are currently pricing in, according to a new note. Commodities surged again on Wednesday, led by WTI, West Texas Intermediate, which surged to its highest levels since May of 2020. This is despite the fact that Russian energy supplies are currently exempt from sanctions, with little talk about changing. Yeah, so we're still buying oil and gas from the Russian Federation. Crude oil markets also completely discounted news that the International Energy Agency would lead a coordinated global release of 60 million barrels of crude. The threat of dumping all that oil into the market didn't sway prices, which only continued their skyward trajectory. In response, the oil price action followed the IEA news and the upcoming oil release Tuesday. Bob Iacono, Path Trading Partners co-founder and chief market strategist, told Yahoo Finance Live that traders and especially hedgers tend to think, wow, they're doing something they don't often do. In the case of the IEA, it's only been done 3 times in their history. Traders will start to think, well, what else do they do? Do they do now? Is this going to get a lot worse than we think? And they'll tend to get all out of sorts, short positions, and tend to even put on long positions. And that's what we think we saw here. All right. See here. Wilson wrote that market participants are still underestimating the tightness in the global oil supplies. He argues that the extra price investors are paying now for futures contracts over the expected spot price when oil futures mature, the so-called risk premium, is still too low and should probably be higher. Kolanovic also believes that energy prices are contained and that the worst may be over. Indirect risks are more substantial given the effects of higher commodity prices on inflation, growth, and consumers. However, one silver lining is that the crisis forced a dovish reassessment of the Fed in the market, he wrote. The Fed's next move. Meanwhile, investors are torn about the Fed's next monetary policy decision at the Federal Open Market Committee meeting on March 16th and 17th. At issue is how much the Fed may increase its short-term benchmark federal funds rate. 1 month ago, prior to the escalation of tensions, markets were pricing in a very hawkish increase of 50 basis points, considered aggressive as the Fed has not moved that much since May of 2000. After the last jaw-dropping inflation print, Fed funds futures actually priced in, if only briefly, a 75 basis point move at the March meeting. Currently, investors believe there's a nearly 100% chance that the Fed will only increase 25 basis points and a minuscule chance that they'll do nothing. In response, yields on the U.S. Treasury securities, which were surging higher before the Ukraine crisis, are now crashing. Wilson believes investors are getting this move wrong and overestimating the Fed's concern over the crisis. We think the market is starting to overestimate the impact of the conflict will have on the Fed trajectory, and so think that front-end rates are ultimately likely to reverse this recent rally, wrote Wilson. Indeed, global skirmishes like these don't tend to disrupt financial markets for long. However, the Fed must respond to one of its key mandates of stable prices. In the current crisis, soaring oil prices are feeding that very inflation, only deepening the Fed's conundrum. Meanwhile, JP Morgan's Marco Kalanovic, taking a different view from Wilson, argues that the Fed will not be aggressive because of the Russia-Ukraine conflict. While the team believes that this will be bullish for U.S. equities, they do not believe that's the case for European stocks, which have much more exposure to any escalation in the conflict. And then it comes to Russian equities. JP Morgan's chief emerging market strategist, Janagir Aziz, said Russia is simply uninvestable. On Monday, the Russian government shut down the Moscow exchange after it had shed nearly 40% in 2 weeks. In the U.S., American deposit receipts of most Russian companies have been halted. Russian ETFs, such as the iShares MSCI Russia ETF, still trade on U.S. exchanges, but without underlying assets to track. ETF managers like BlackRock are halting the creation of new ETF units. So it's kind of a mixed bag. Some people think that this is going to be the markets are going to continue on their trend, and this is little to worry about. Others seem to think that things are headed in a negative direction, especially with the inflationary pressure that we're seeing. And a lot of people are split on whether the Fed is going to go with a 50 basis point or 0.5% rate increase, or only do 0.25%. I personally would like to see 0.5%. I'd like to see us above 1% by summertime. But if we don't get above, get the interest rates at or near the inflation rate, it's just never going to really come down. At least not in a significant or in a quick manner. So, all right. So this bill could give you an extra $60,000 tax deduction. This is discussing a bill going through Congress right now. This is from Patrick Villanueva. All right. Americans who rely on state and local tax deductions at tax time may be in luck. A Democrat proposal aims to restore the SALT deduction for taxpayers who make less than $400,000 a year and increase the deduction cap for Americans who make up to $1 million. The Supporting Americans and Lower Taxes Act, sponsored by U.S. Reps Tom Malinowski, Katie Porter, would undo the $10,000 cap on SALT deduction instituted in 2018 under former President Donald Trump. Here's a look at how the SALT deduction and how proposed legislation could impact your finances. All right. The state and local tax deduction has existed since the federal income tax was introduced in 1913. The provision allowed taxpayers who itemized to deduct property, sales, and/or income taxes they paid to the state or local governments on their federal income taxes. Previously, there was no cap on SALT deductions. This allowed taxpayers to deduct as many state and local taxes from their federal income. However, the Tax Cuts and Jobs Act created a $10,000 limit on the deduction, disproportionately affecting high-income earners in high-tax states. Critics argue that the SALT deduction is merely a tax loophole for the wealthy. Prior to the Tax Cuts and Jobs Act, taxpayers making at least $100,000 a year realized 91% of the benefit of the SALT deduction, according to the Tax Foundation. All right, so here's how it would change. While the $10,000 ceiling on the SALT deduction is set to expire at the end of 2025 under the TCJA, Malinowski and Porter hope to reform the tax code before that happens. Under the SALT Act, people making less than 400,000 will once again be permitted to deduct all state and local taxes on their federal income tax returns, provided they itemize their deductions. But instead of lifting the cap for all taxpayers under the proposed legislation, the deduct would start at 60,000 for those making over 400,000 and reduce to a rate of 10,000 for each 100,000 income thereafter. Pointing to tax foundation estimates, Malinowski and Porter say their bill will raise 150.9 billion over 10 years, compared to maintaining the $10,000 ceiling through 2025 and then allowing it to expire completely. Under the proposed legislation, the revenue would be used to create a Medicare Vision and Hearing Trust Fund and pay for hearing and vision benefits. Well, see, if we didn't spend the trust fund the first time, we wouldn't have to be making that up. Our tax code should provide a level playing field across the states, not punish some Americans for living in regions with high cost of living. Porter said in a statement, our SALT Act will restore fairness to our tax code with sensible guardrails to prevent abuse of the ultra wealthy. Benjamin Silman, a professor of accountancy at St. John's University in New York, said the legislation would reset the tax base more equitably and have a positive impact. However, he offered a caveat. In many states, the cap on SALT deductions causes taxpayers to have to fork over even more money to the federal government. In the end, increasing the SALT deduction cap will be a step in the right direction, Silman said. One reality that this proposal lacks is a large portion of the SALT deduction goes to property owners, where lower and middle income taxpayers who do not own homes may not benefit from the SALT deduction. This will have to be addressed by Congress sooner rather than later. Well, I'm not really concerned about people who rent. That is a them problem. All right, so this will be attached. So if you want to finish it up, personally, I don't think you should get a deduction for your state and local taxes. That would just make it fair across the board. Granted, we pay way too much in federal tax. I know my wife and I donate about a third of our salaries to the federal government and get nothing back in return. And for any of you who say, well, you get protection, you get the military. Well, the military is not protecting me. It's doing crap around the world at a very expensive cost. So I'm not really worried about that. All right. Last article I have here. This is just has to do with what's going on right now. This is Did We Provoke Putin's War in Ukraine? Written by Patrick J. Buchanan. Mr. Buchanan was a presidential candidate back, probably 30 years ago. So let's go ahead and dive into this and get his take on things. When Russia's Vladimir Putin demanded that the U.S. rule out Ukraine as future member of the NATO alliance, the U.S. archly replied, NATO has an open door policy. Any nation, including Ukraine, may apply for membership and be admitted. We're not changing that. In the Bucharest Declaration of 2008, NATO had put Ukraine and Georgia even farther east in the Caucasus on a path to membership in NATO and coverage under Article 5 of the treaty, which declares an attack on any one member is an attack on all. Unable to get satisfactory answers to his demand, Putin invaded and settled the issue. Neither Ukraine nor Georgia will become members of NATO. To prevent that, Russia will go to war, and as Russia did last night. Putin did exactly what he warned us he would do. Whenever the character of the Russian president, now being hotly debated here in the U.S., has established his credibility. When Putin warns he'll do something, he does it. 36 hours into the Russia-Ukraine war, potentially the worst in Europe since 1945, two questions need to be answered. How did we get here? And where do we go from here? How did we get to where Russia, believing its back is against the wall and the United States, by moving NATO even closer, put it there, reached a point where it chose war with Ukraine rather than accepting the fate and future it believes the West has in store for Mother Russia? Consider between 1989 and 1991, Mikhail Gorbachev let the Berlin Wall be pulled down, Germany be reunited, and all the captive nations of Eastern Europe go free. Having collapsed the Soviet Empire, Gorbachev allowed the Soviet Union to dissolve itself into 15 independent nations. Communism was never allowed to expire as the ruling ideology of Russia, and the land where Leninism and Bolshevism first took root in 1917. Gorbachev called off the Cold War in Europe by removing all the causes on Moscow's side of the historic divide. Putin, a former KGB colonel, came to power in 1999 after a disastrous decade-long rule of Boris Yeltsin, who ran Russia into the ground. In that year, 1999, Putin watched as America conducted a 78-day bombing campaign on Serbia, the Balkan nation that had historically been a protectorate of Mother Russia. Um, uh, that year, also, three former Warsaw Pact nations, the Czech Republic, Hungary, and Poland, were brought into NATO, against whom were these countries to be protected by U.S. arms and the NATO alliance. The question was fairly asked. The question seemed to be answered fully in 2004 when Slovenia, Slovakia, Lithuania, Latvia, Estonia, Romania, and Bulgaria were admitted into NATO, a grouping that included three former former republics of the USSR itself, as well as three more former Warsaw Pact nations. Then in 2008 came the Bucharest Declaration that put Georgia and Ukraine, both bordering on Russia, on path to NATO membership. Georgia, the same year, attacked its preceding province of South Ossetia, where Russian troops were acting as peacekeepers, killing some. This triggered a Putin counterattack through a rocky tunnel in North Ossetia that liberated South Ossetia and moved into Georgia all the way to Gori, the birthplace of Stalin. George W. Bush, who had pledged to end tyranny in our world, did nothing. After briefly occupying part of Georgia, the Russians departed but stayed as protectors of the South Ossetians. The U.S. Establishment has declared this to have been a Russian war of aggression, but an EU investigation blamed Georgian President Mikhail Saakashvili for starting the war. In 2014, a democratically elected pro-Russian president of Ukraine, Viktor Yanukovych, was overthrown in Kiev and replaced by a pro-Western regime. Rather than lose Sevastopol, Russia's historic naval base in Crimea, Putin seized the peninsula and declared it Russian territory. Teddy Roosevelt stole Panama with similar remorse, which brings us to today. Whenever we may think of Putin, he is no Stalin. He has not murdered millions or created a Gulag archipelago, nor is he irrational as some pundits rail. He does not want a war with us, which would be worse than ruinous to both of us, or to us both. Putin is a Russian nationalist, patriot, traditionalist, and cold and ruthless realist, looking out to preserve Russia as the great and respected power it once was, and he believes it can be again. But it cannot be if NATO expansion does not stop, or if its sister state of Ukraine becomes part of a military alliance whose proudest boast is that it won the Cold War against the nation Putin has served all his life. President Joe Biden almost hourly promises we are not going to war in Ukraine. Why would he then not readily rule out NATO membership for Ukraine, which would require us to do something Biden himself says Americans, for our own survival, should never do: go to war with Russia? So definitely an interesting look at the backdrop, which has led us to this point. So, I'm not taking sides either way. I'm very much a pacifist. I do not believe in harming innocent people or using aggression against those who aren't using aggression against me. So, I don't know, there are no winners or losers or good guys or bad guys in this situation. We, the West, and the NATO countries have been slowly, incrementally scooching our ways towards Russia. Russia doesn't like it. I can totally understand it. If you think back to what was that? When the nukes were in Cuba back in 62, 63, we didn't like that either. And Kennedy basically put his foot down and told Khrushchev, "Hey, get these missiles out of here or else." And at the same time, Khrushchev said, "Hey, get your missiles out of Turkey," and we got a deal, which we did. Unfortunately, he had to send his brother Bobby over because he couldn't really trust anyone in our own government to do that. But it de-escalated, and we had 60 years of relative peace between the two countries. I mean, I served in the Navy shortly after the Cold War, and it still was a thing. We didn't have a lot of love for the Ruskies, but or 30 years later, I have no ill will towards anybody. So now the government, our own government, I can't stand. I'd like to see all those bastards, hung from trees that work in the the Capitol. But hey, maybe I'll get that chance sooner than later after the people who run our government run it into the ground. So, all right. Well, that's everything I have for today. I hope everyone is having a wonderful day out there and has a wonderful Tuesday evening. Cougars going to be on tonight, so go Cougs. They after those 2 losses they had a couple of weeks ago have turned it back around. I think they've won 3 straight since then. Heading into the last few games of the season before conference tournaments start up, I think next week, maybe the week after, and then March Madness. Whew, my favorite time of year is right behind that. Unfortunately, baseball season will not be following the March Madness season, unfortunately, unless the owners and the players get their crap together. But anyways, we can talk baseball offline. Anyone who wants to give me a call and talk baseball, feel free. All right. Well, hope everyone has a great evening, and I will be back tomorrow with the day's events in the market for Wednesday. So hope everyone has a great night, and I'll talk to you then.